If you think your money in the bank is absolutely safe, you might not be prepared for one harsh reality. Even the giants can fall. In just a matter of days, thousands of Americans could lose access to their accounts. Businesses might fail to withdraw funds for payroll. This is nothing short of a catastrophic scenario. And when a major bank collapses, the domino effect doesn't stop there. The stock market plunges. Retirement funds vanish. People rush to withdraw their savings only to discover there's nothing left to withdraw. This isn't a Hollywood movie script. It has happened before, and now the warnings are resurfacing right in the heart of America. What would happen if the largest banks disappear one after another? You need to know before it knocks on your door. The banking system, the heart of the American economy. When you receive your paycheck, pay your bills, buy a house, or simply save money for the future, you rely on one system, the banks. They're not just a place to store money. They are the main arteries pumping blood throughout the entire American economy. Major banks like JP Chase, Bank of America, Citigroup, and Wells Fargo don't just manage trillions of dollars in assets. They provide loans to businesses, help people buy homes, cars, and invest in education. They are the bridge between savers and borrowers, between dreams and reality. According to data from the Financial Services Forum, America's top banks have deployed nearly $5 trillion in loans to businesses and families, nationwide, driving growth and creating jobs. Yet this system is not invincible. The 2008 financial crisis was the clearest proof. When Lehman Brothers collapsed, it triggered a chain reaction, sending the stock market into freefall, costing millions of jobs and shaking public confidence in the financial system. More recently, in 2023, the collapse of Silicon Valley Bank and Signature Bank once again raised concerns about the stability of the banking system, especially regional banks. Moody's downgraded the outlook for the U.S. banking system to negative, reflecting a rapid deterioration in the sector's financial foundation. This raises a serious question. What would happen if a major bank collapses? It's not just about numbers on a financial report. It's about the lives of millions of Americans who rely on this system for their livelihood and financial security. In the next section, we will explore the potential causes behind the collapse of major banks and why this poses a severe threat to the economy and the everyday lives of American citizens. Causes of collapse. Lessons from the past. Let's take a trip back to 2008, a time that still haunts millions of Americans. It was an ordinary day. You were sipping your morning coffee, watching the news, when suddenly Lehman Brothers, one of the largest investment banks in the United States, declared bankruptcy. Within days, the stock market plunged, hundreds of thousands lost their jobs, homes were foreclosed, and the economy spiraled into a severe recession. But the question is, how could banks that seemed too big to fail collapse so quickly? And what if it happens again, not just one, but several major banks at once? The story begins with mistakes that seemed harmless, yet when combined, they became a toxic brew for the entire financial system. Weak risk management banks are supposed to be places where people trust their money will be safe, used responsibly, and earn interest. But behind the glass walls of these impressive buildings, many banks operated like underground casinos, where billions of dollars were wagered on risky assets without proper oversight. Proper risk management means knowing when to stop. But in many banks, especially during periods of rapid growth, greed overshadowed caution. They ignored warnings, dismissed cautious evaluations from experts, and continued pouring money into risky loans from real estate and corporate bonds to complex financial products that even bank executives sometimes didn't fully understand. The result? When interest rates rose and markets shifted, those smart investments suddenly turned into a mountain of bad debt. And the first to suffer were not the CEOs, but the depositors, investing in high-risk assets. You may have heard the term subprime mortgage home loans given to people with poor credit. Before 2008, banks rushed to offer such loans because they promised high profits even though they knew borrowers were unlikely to repay. Similarly, in recent years, we have seen U.S. banks heavily investing in assets that seemed safe, like long-term government bonds. But this is where we learned a lesson from the Silicon Valley Bank collapse in 2023. SVB bought massive amounts of long-term bonds when interest rates were low. When the Federal Reserve rapidly raised interest rates to fight inflation, the value of these bonds plummeted. And when customers rushed to withdraw their money, the bank was forced to sell those bonds at huge losses, leading to insolvency. SVB's story was not an exception. It is clear proof that in a volatile economy, no asset is truly absolutely safe. When banks place their bets at the wrong time, the consequences are not just negative numbers on a financial report. They are a loss of public trust, interest rate policies, and the invisible power of the Fed. The Federal Reserve is often described as the captain of the U.S. economy. Every time it adjusts interest rates, the entire American financial market from Wall Street to your wallet feels the impact. For over a decade, the Fed kept interest rates low, making it easy for banks to borrow cheap money and invest in high-yield assets. But this also created an illusion of safety. When inflation spiraled out of control, the Fed was forced to raise rates sharply. As a result, many banks got caught in a liquidity trap. Their assets lost value while customers rushed to withdraw deposits. No bank can survive when people lose confidence. A single rumor on social media can trigger a bank run a massive rush to withdraw money out of fear of losing everything. This happened to Signature Bank, which served thousands of small businesses, and it collapsed just days after SVB technology and the speed of panic. In the past, withdrawing money meant physically going to the bank, waiting in line, and signing papers. Now it takes just a tap on your phone. During the SVB crisis, billions of dollars were withdrawn within hours, faster than any bank had ever experienced. A tweet, a message in an investor group chat, or a whispered insider tip is enough to cause mass panic. Technology has made life more convenient, but it has also made crises spread at lightning speed. And the scariest part? Most people don't know what's true and what's just a rumor. In a panic, everyone acts the same. They withdraw money before it's too late. Lack of oversight and regulation. After the 2008 crisis, the US government passed the Dodd-Frank Act to strengthen oversight of financial institutions. But in 2018, parts of this law were loosened under pressure from mid-sized banks, including SVB and Signature. As a result, these banks were no longer subject to strict stress tests or required to maintain high reserve levels. And when the market changed direction, they were not strong enough to withstand the shock. The lesson here is clear. When regulatory oversight is weakened, banks can game the system, chasing maximum profits while ignoring long-term safety, but the public has no right to make mistakes. A harsh reality, lessons from the past. Looking back, we see that the collapse of a bank is not just a Wall Street story, it is a story of everyday families. It is about parents who can no longer withdraw their savings to pay for their children's education. It is about small business owners who are denied loans during peak seasons. It is about factory workers losing their jobs because companies can't survive. And if tomorrow another major bank collapses, the question is not why, but have we learned enough from the past? Financial stability doesn't come from luck, it comes from discipline, transparency, and responsibility. A healthy economy cannot stand on a shaky foundation of greed and complacency. Will America repeat the same old tragedy in a new era? Or this time, have we become wise enough to avoid the traps of short-term profit? Terrifying consequences for America. Imagine an ordinary morning. You wake up, brew a hot cup of coffee, and check your bank account as usual, but this time something's off. You can't access your account, or worse, the balance shows zero. You call the bank, but no one answers. The app displays system disruption. Then you turn on the TV and see your bank's name on the morning news alongside two dreaded words, bankrupt. This is no longer just a Hollywood movie scene. It's a scenario that has happened before and could happen again this time on a much larger scale. When a major bank collapses, the first thing to disappear is trust. And once trust wavers, everything else can collapse faster than you can imagine. For Americans, especially workers, retirees, and those living on fixed incomes. The most terrifying prospect isn't the stock market plunging or Bitcoin crashing. It's losing their savings. The money you painstakingly saved over a lifetime, every dollar put away, every paycheck transferred to your retirement fund, now gone with a single click. Of course, there's the FDIC deposit insurance, but do you know the limit? $250,000. For many, that's enough. But for small businesses, investors, or people with multiple accounts, anything beyond that is not protected. In the Silicon Valley Bank SVB crisis of 2023, nearly 90% of deposits were uninsured. And for 72 long hours, thousands of people lived in fear, uncertain if their money was safe or had vanished. And do you know what happened next? People rushed to withdraw money from other banks simply out of fear. A wave of panic spread. And when millions of people all try to withdraw their money at once, even the strongest banks can't survive. Banks don't keep piles of cash in their vaults, like in the movies. That money is invested, loaned out, or used to buy bonds. When everyone demands their money back, immediately banks are forced to sell off assets, suffering massive losses, and then they collapse. But that's just the first blow. The second and far more devastating consequence is the mass death of businesses. Banks aren't just places to store money, they are the lifeblood of the economy. Have a small business? Need a loan to pay salaries? Expand your workshop? Stock up for the holiday season? Forget it. No bank will lend during a crisis. They close their books, cut off credit, and suspend all investment plans. And when businesses can't get funding, they don't hire more workers. They cut back. They lay off employees, and the unemployed without money to spend cause other sectors' retail shipping services to spiral down. A recession begins transforming invisible numbers on a balance sheet into real-life struggles over basic needs. Then comes the stock market crash. When banks fail, financial stocks plummet, investors panic sell. Those with 400 retirement plans, elderly people relying on dividend income, they watch their assets lose value every day. Helpless. Worse still, many insurance companies and financial institutions also invest in banks, creating a domino effect that spreads across industries once thought unrelated. But how do ordinary people feel the crisis? Very simply, you lose your job, can't get a loan, prices skyrocket, but your wages stay the same. Monthly payments become a burden. You start cutting expenses and soon find yourself living a completely different life than just a few months ago. Yet the most heartbreaking thing is this trust is shattered. When bank symbols of stability can collapse, people begin to wonder, is anywhere safe? They start hoarding cash, flocking to gold real estate, or even stuffing money under their mattresses. This leads to a withdrawn society where no one trusts anyone, no one dares to invest, and no one takes risks. And then to save the entire system, the government is forced to intervene. Bailouts, money printing, nationalizing banks. But where does that money come from? From the people. By printing more money, raising taxes, or cutting public spending. This means services like healthcare, education, and elderly benefits could be reduced. People lose both their money and their social safety nets. This is the true cost of collapse. Not just a few banks, but a collapse of trust that fractures every family and community, and it gets worse if America, the world's largest economy, falls into crisis. Global markets tremble. The US dollar loses value. Other nations flee American markets. A global financial crisis could begin like in 2008, but deeper, broader, and longer. So when someone says a bank collapse doesn't affect me, please think again. We live in an interconnected world. When one major link breaks, the entire chain can be pulled down. And the first ones to be dragged down are not those on Wall Street, but those on Main Street, where you, I, and millions of working Americans struggle to make a living every day. Could we stand strong if another major bank disappeared tomorrow? Or would we once again become victims of a crisis that no one saw coming, but everyone should have seen from miles away? Response, measures, and resilience. Have you ever wondered if one day the bank where you keep your money suddenly shuts down? What would you do? This is not just a hypothetical scenario. In 2023, millions of Americans experienced that exact feeling when Silicon Valley Bank and Signature Bank collapsed within just a few days. But the important question is, how did the US financial system respond to prevent a wider crisis? Let's take a closer look at the measures that the government and the Federal Reserve implemented to protect citizens and the economy. When it comes to the safety of deposits, most people immediately think of the FDIC, the Federal Deposit Insurance Corporation. The FDIC ensures that each depositor is insured up to $250,000 per insured bank per account type. This means if you have accounts at multiple banks, each account is separately insured. During the 2023 crisis, the FDIC acted quickly to ensure that all deposits, even those exceeding the insurance limit, were protected. This move prevented widespread panic and mass withdrawals, which could have led to the collapse of many other banks. When a bank faces a mass withdrawal, it needs cash to meet customer demands. But what happens if it doesn't have enough cash? This is where the Fed steps in. On March 12, 2023, the Fed launched the Bank Term Funding Program, which allowed banks to borrow money for up to 1 year using assets like government bonds as collateral. The unique aspect was that these assets were valued at face value rather than market value, helping banks avoid selling assets at a loss just to obtain cash. This program provided hundreds of billions of dollars to banks, ensuring they maintained liquidity and could continue serving customers normally. If a bank cannot save itself, the last resort is restructuring or merging with another bank. For example, when First Republic Bank encountered difficulties, the FDIC stepped in and arranged for JP Chase to acquire it. This move protected depositors and maintained the stability of the banking system. After the crisis, regulators learned several valuable lessons. One of the most important was the need to enhance supervision and require banks to be more transparent about unrealized losses. This helps identify risks early and prevent collapses before it's too late. So what should individuals do? Although the government and the Fed have taken strong measures to protect the financial system, each person must also proactively protect their own assets. Here are a few suggestions. Diversify your assets. Don't put all your eggs in one basket. Spread your deposits across multiple banks to maximize FDIC insurance coverage. Stay informed. Keep up with financial news and government policies to make timely decisions. Seek expert advice. If you are unsure how to protect your assets, consult with financial experts. A warning for American citizens. One of the strongest pillars of the U.S. financial system is the Federal Deposit Insurance Corporation, FDIC, established in 1933. The FDIC is responsible for protecting depositors and maintaining the stability of the banking system. When a bank faces trouble, the FDIC can take measures such as facilitating a purchase and assumption agreement, paying out insured deposits, or supporting an open bank to ensure depositors' rights and prevent the crisis from spreading. For instance, during the 2008 global financial crisis, the FDIC effectively managed over 300 bank failures without using taxpayer money. This demonstrated the importance of having a strong and independent deposit insurance system. In addition, the Federal Reserve plays a crucial role in providing emergency liquidity to banks in distress. By offering flexible lending options and financial support, the Fed helps prevent bank collapses and maintains public confidence in the financial system. Another measure is the restructuring and merging of weak banks with stronger financial institutions. This approach not only saves struggling banks but also strengthens the overall banking system, creating financial institutions with better financial capacity and management. However, it is not just the regulators who have a role in responding to a banking crisis. Citizens also need to increase their financial literacy, diversify their assets, and stay informed about financial news to protect themselves from market volatility. Ultimately, maintaining a stable and secure financial system is a shared responsibility of the government, financial institutions, and the public. Through cooperation and preventive measures, we can minimize risks and ensure the safety of the national economy. If another major bank collapses tomorrow, are you prepared? It's not just about the money in your account, but also the financial security of your family, the future of your children, and your peace of mind every time you go to bed. Crises never knock before they arrive, and if we are not alert, not proactive, we'll be the ones suffering the consequences. What do you think? Is the current financial system strong enough to protect you in a crisis? Share your thoughts in the comments. We want to hear from you. This video is not intended to provide personal financial advice or promote panic. All content is presented for the purpose of exploration, analysis, and encouraging discussion based on current events, data, and social trends. We respect the U.S. Constitution and all federal laws. If you found this video useful, don't forget to like, subscribe, and turn on the notification bell so you won't miss our latest content where we uncover stories that mainstream media may overlook. Let's build a community that is knowledgeable, alert, and capable of protecting itself in this ever-changing era.